Hello, everybody, and welcome to the latest CodeBase on the couch. I think I'll probably just let time tick over for another couple of minutes as I can see the number of people who are attending ticking up a little bit. And I know that people who perhaps schedule their day around their work calendar will be leaving one thing and joining another. Yeah, we've doubled the number of participants in the last 10 seconds. So let's just hang on for a couple more minutes until we've got a few more people with us. I think this is my first CodeBase on the couch. I know for Isabella also, your first CodeBase on the couch. Familiar faces not available to host today. So I think let's get to it. So this is CodeBase on the Couch webinar. My name's Martin. I work at CodeBase. Normally I'm based in the office in Edinburgh, but today I'm at my home in Edinburgh, as you can see. I've got the light on because it's a bit of a grey day out. We're delighted today to be joined by Isabella Ghassemi-Smith, who is from SeedLegals. I think probably, Isabella, let's get straight to it, shall we? I think that people are probably quite familiar with CodeBase, given that they've joined, they probably joined through from our marketing OU. So let's hand over to you. If you want to do a little bit of an intro, both to say hello from your perspective and to kind of give a bit of context as to what SeedLegals is for those not familiar, and then just crack on into the presentation and we can structure it from there.
Yeah, great. Thank you very much, Martin. So for everyone to make sure they're in the right place, today is everything to do with getting investment ready and getting funded, which in itself is quite a large topic, and I can't say I will necessarily have all the answers, but the basis of today is so you know all the A to Z points that you need to have in place if you're at the point where you are looking to raise investment or you're in the actual process of fundraising at the moment. Now, the way I like to break it down generally is into four main points. So the first is, you're at this honeymoon stage, you've come up with this amazing idea, you're going to change the world. And then you have to go through the arduous task of actually getting that idea investment ready and protecting yourself as a founder, right? And then once you do all of that, you start speaking to investors and you need to send the right contracts to the investors and know what the investors are talking about to raise investment. And then you're at this stage where, hey, I've got loads of money in the bank, but what do I do with it? So to start on the first thing, you're a founder, you have a co-founder, or maybe you don't, and you've come up with this great idea, right? But then lockdown hits and things get difficult and you may get furloughed and everything's taking too long and you're not making any money and someone leaves. Now, from the stats that we have, about 10% of founders do leave and split up. And that's why the first and foremost thing you have to have in place when you're starting a company is a founder's agreement, which may seem very straightforward. Most of you probably have one in place, but the actual part that is even more important in a founder's agreement is the share vesting schedule, right? So if you don't know what a share vesting schedule is, basically, rather than you and me getting our shares up front, I have 50% and you have 50%. And that's it. And then if you leave with those 50%. The way that this works is I have 50% and you have 50%, but if you leave before the agreed amount of time, which on average is about 3 years, you have to give a percentage of your shares back. And the reason for that is that, well, let's say hypothetically we didn't have a share vesting schedule in place, right? You would leave the company with half the amount of shares, and suddenly enough, the company becomes uninvestable because 50% of it are ghost shares that are not bringing in new capital, not bringing in new clients, and not contributing to the overall growth, right? So when you set up a founder's agreement, you need to have a share vesting schedule in place. And now this isn't a matter of you protecting yourself as a founder. Investors will not invest in you if you do not have one in place. And typically they'll introduce a more harsh share vesting schedule, more along the lines of 4, 5, 6, 7 years, because you didn't have one in place and they think you're a bit of a rookie founder. Now, you should know the average period is 3 years. So you join, you create this company, and then after 3 years of commitment and fulfilling your responsibilities, you have a right, if you wanted to actually cash in and take out your shares. Now, the second part of that I think a lot of people underestimate is protecting your intellectual property. So like, what is intellectual property? There are many definitions of it, but it's not just, something you patent like your cure to cancer or like the magic source of your business. Not really. Intellectual property is everything from, your website design to your source code to the images you use everything that make up this ethos of the business. So you think if you pay a third-party web agency to build your website, you paid good money for it, you probably assume that you own the rights to that website, right? It's not necessarily true unless actually stated in the contracts. And because quite a few web designers are aware that most founders don't know this, some are a little bit cheeky and essentially might come back to you, you know, a few months down the line, once you've raised a really solid bit of investment and said, hey, remember me? Like, we worked together a few months ago. Congrats on your raise. And if you want the rights to your website, you need to pay me $3,000. And I've seen that happen. So when you have an intellectual property and IP assignment, you should really have that in place, just stating, okay, like, really good working with you, but we own the rights to it. Well, the company owns the rights to the website. Similarly, if you have a designer working for you, right? Like an in-house designer, you can't just assume you own the rights to what he's building. That needs to be implemented within his employment agreement and also within an IP assignment. So that's very, very kind of just the basics that you're going to want to have in place, and that also investors are looking for as the preliminary checklist before they even think about investing in your business. Now, the next part of that is SEIS and EIS advanced assurance. So when lockdown hit, I had a bit of a different twist on how you should use it. I was saying, look, if you really want to raise investment and you really feel like you need to raise investment, just raise 150K of SEIS and EIS investment. I'm not really going to say that anymore. I don't think it's true. I think the market has massively stabilized and we've seen that amongst our investors. So what is SEIS and EIS advanced assurance? Well, if you don't know, if there's one thing I want you to take from this webinar, it's this, and literally just this: 90% of all early stage investment in the UK is funneled through SEIS and EIS advanced assurance funds. What that means is basically in 1992, HMRC waltzed in and they said, we want more investment in our early stage companies. They told the angel investors and individuals, look, if you invest in these companies, you will get a tax break. So with SEIS funds, you can take up to 150 grand in total, not per investor, but in total, where those contributors get a 50% discount on their tax, so capital gain tax. Then you can get up to £12 million of EIS funds, where those contributors get a 30% tax break on their capital gains tax and so on and so forth. So it's a huge incentive, and it's one of the reasons that makes London, or the UK actually, such a hub for startup growth, because nowhere else will you get this tax break. In terms of applying for it, the advanced assurance is basically this document you get from HMRC saying, yes, your company is eligible to offer this tax break to your investors will get a tax break. If you do not have this document, your investor is very unlikely to invest in you, because although you don't necessarily need it, they want it. They want that assurance that they're not investing in you and then suddenly you can't give them that tax break. A little bit of stats around the approval rate. So the market standard approval rate is 64% amongst accountants who may charge you £3,000 for it. Please don't do that. If you're going to pay an accountant, just do it yourself. If you want to do it yourself, I can send you loads of resources on what the best way to do it and what to be aware of. However, if you are pressed for time and you'd like to have it done now, because we saw it was a huge issue for founders, we basically automated it just so founders don't fall in this trap. And we set it at the cheapest price we could to not actually lose money on it. So we have a 98% approval rate, and we get you approved within 3 to 5 working days. The general time frame is about 4 to 6 weeks. So look, if you're looking to fundraise and you don't have the time to wait, and an investor said, have you applied for advanced assurance, and you want to make sure you can say yes, I would do it as quickly as possible. But just remember SEIS and EIS advanced assurance. So then you've protected yourself as a founder and you have your SEIS and EIS advanced assurance, and then you come to this really weird question of like, how do you value your company? And you're thinking, well, if you're early stage at least, you're thinking, well, I've never really generated revenue at this point, right? Like, this is why we need the money. Like, how do you want me to value my company? And normally you have about 4 conversations, and the first is with your accountant, who this is what I didn't actually do this. I've been told this, but the first is actually with your accountant, and he says, how much revenue have you made? And you say none. And he's okay, that's fine. How much revenue are you projected to make in the next years? And you say, no, none. I think we're going to lose money, like most startups do. And then he'll say, well, your valuation is 0. Not true. So then you might go on to UKTN and you might look at companies of your type and size and how much they are, valued at, but it doesn't normally say how much they raise. So it's useful, but And then you might go on to TechCrunch and see what American companies are raising and being valued at. Although I will be very clear very quickly, the UK market does not operate on that kind of inflation. If you're going to take one of those numbers, take about 3 zeros off the end just as a standard, and maybe take another one off because we're in lockdown and valuations have shot down actually. So then you might be like, okay, right, you know what, I'm starting a business. I can just create an Excel spreadsheet, bing, bada, boom. I've got my valuation, put in some financial variations, that's fine. The thing is about that is that you've obviously never really operated much money before. So it's, you know, when you say our marketing campaign is going to give us X returns, like it's really hard for an investor to believe that. So we were like, well, there must be a better way. And we work with about 14,000 founders. We've raised over 200 million plus on the platform. And we saw a lot of data because we're a data company at the end of the day, right? And what we realized is that founders are raising 1 to 2 times a year. So the classic kind of every 6 to 12 to 18 months. And they're giving away in total 15% equity. Now, this is to do with founders who actually raised again after this, founders who, you know, managed to grow and become real companies. And you're thinking, but you were just talking about valuation. Why are you talking about how much equity they gave away? Well, because you know 2 things, right? Which is, this is how much equity I want to give away, and this is how much money I need to get to my next landmark in about 12 to 18 months. That you can justify, right? Because you can say, well, I need to pay for my SaaS subscriptions, I need to pay for office space, maybe not so much now, but I need to hire someone. Like, this is the money I'll need. And so you have that number. Now, going back to knowing how much equity you should give away, we'll put it this way. Let's say hypothetically you give away 20% in your first round. You raise, I don't know, 100 grand. Then you give it 20% in your next round. You raise another like 400 grand. And then you give 20% in your next round. And you had a pre-Series A, and you've kind of raised $1 million, right? Or your early Series A. You've done 3 rounds, raised under £2 million in total, and you give away 60% of your company. You will never be able to raise with any institutional investors or a VC simply because you do not have enough equity to play around with, and you've massively diluted yourself as a founder to the point that they think you don't have any stake in the game, right? Whereas, let's say you give 15% equity away or less, right? But maximum 15% equity. And then you give another 15% equity. And then you give another 15% equity. Like, you've raised a good amount of money. You've used that money. You've raised more money. And you've only given away 45% of your company. So this isn't an opinion. You can do what you want. But this is what the data is saying. And generally, if you're kind of going, if an investor is coming to you saying, I'll give you 100 grand for 30%, my guess is he's not a very good investor and he doesn't really understand what's going on. Because if you do that twice, you just won't really be able to grow much, right? So just keep that in mind. Now, of course, this isn't the Bible, but it is worth taking into account. So let's say hypothetically, you want to raise 100 grand, you're going to give away 15%. If you do the maths quite quickly, I'm terrible at maths, but if you do the maths quite quickly, your valuation pre-money would be around, you know, 650,000 pounds, which is it's nothing, right? It is nothing, but you're at a pre-seed stage. You've never really used money before. Where it becomes really clear what a valuation will look like is when you actually start using that money and seeing the returns on what you're spending on and how you're growing. And then your next valuation, it's more of an art and a science. You know, they always say valuations are like an art and a science. Well, here it's very much science. Look, you need this much money, you need to give away this much equity, fine. And then once the money comes in, you can be a lot clearer. Also, just another reason the valuations are a little bit timid on the get-go, or like set at $1 million or something. The reason for that is very much because you never want to set too high a valuation to the point that when the money does come in, you can't actually meet it. Do you know what I mean? Like, money comes in, you want to raise in 12 months, you realize you're never going to meet that because you haven't turned that much profit. So you don't want to go through a down round. It's much easier to make that call after money's in play. Now, this might be a little bit confusing. I'm happy to elaborate in questions, but that's just a few things to keep in mind. Now, I mentioned the word pre-money valuation, right? Your pre-money valuation. If you don't know what that is, your pre-money valuation is that magical number you've come up with that isn't actually based on much apart from, well, we want to raise this much and we want to give away this much equity. We're going to set this number. Your post money valuation is that number plus the actual amount of investment you raise. So if you're raising at 650k valuation and the money your investors are giving you is 100k, your post money valuation is 750k. Now, why am I talking about this and why is it so boring? Well, the reason that we're talking about it is because when you talk to investors and you're at that stage where you've protected yourself as a founder, you've got SEIS advanced assurance, you've set some kind of valuation, what valuation do you talk about when you message your investors? And the reason you should use pre-money is because it's a fixed target. So what do I mean by this? Well, let's say hypothetically you used a post-money valuation, post-money. Valuation of 650k, you're raising 100k, 750 grand post-money valuation. And you email all your investors, you're about to close your round, you say, hello, ladies and gentlemen, very excited to close this round at a 750k post-money valuation, looking to close tomorrow. And then lockdown hits and one of your investors emails you and says, look, I'm going to have to pull out 30 grand, like I need to funnel it into my other portfolio companies, I'm really sorry. And then you have to email all of your investors saying, hello, ladies and gentlemen, unfortunately, we've closed at a 720 post-money valuation. And your investors are thinking, why has the valuation changed, right? Like, what's happened? It doesn't look good. And it's not, your valuation hasn't changed. The amount of money you've raised has changed. And the thing is investors can come and go, and it's so hard to predict, even if they've signed the term sheet. So just set yourself with the pre-money valuation. It's a fixed target. You don't have to have that inconsistency, okay? Why equity? Look, I think you guys all know this. Equity is great because there's no personal liability, and you can raise and not have that stress of having your house on the line. Also, it's unlikely to be able to raise with like a bank or something without, putting in significant collateral. But more than anything, and this is what every great founder will say, your angel investors are more than just financial capital. They have intellectual capital too. They've been through these rounds before. They have experience, particularly in a time like lockdown. They are very, very intelligent. So when you speak to an investor, you ask him for advice before you ask him for investment, is my general opinion. Actually, it's not my general opinion, it's the opinion that through many interviews we've come to see is the approach that you should take. Companies that used to get, and the reason I'm shaking my head at this is because before, companies would say, I have this great idea, but I need like 50 grand to implement it, and they would raise investment. And I'm not saying that's wrong or that's right, but all I'm saying now is those kind of companies will not raise now. So if you are in ideation stage and you haven't have a proof of concept, you haven't sent out a type form, you haven't created a landing page showing people emailing, you're not going to raise investment. You need to show, I'm not saying you need the product, but you need to show that there is a demand for what you're doing, and you haven't just created something that you think is cool, like other people think it's cool. Now, the best story I can give about that, and I think it's a great story, is the story of Buffer. Okay, everyone knows the social media platform, except at the time there wasn't a lot of social media scheduling platforms where you could post in America, but time it and not have to wake up at 4 a.m. So they raised interest really quickly. And this investor at the time said, I'll give you 100 grand for 30%. 100 grand was a lot of money back then. At the beginning, they were like, this is great. We can pay for a marketer. We can pay for these ads. We can do all these things. And then very quickly, there were two founders, one business guy and one techie. The techie was like, I don't even know if people want what we're creating. Like, we want to schedule social media posts. Who wants that, So they did two things really simply. They created a first landing page that basically said, this is what we're going to do. This is how we want to make your life easier. If you're interested, sign up. People signed up. They get an email saying, you're a little bit too early, but stick with us. And we'll see. And then they gained a lot of traction. And then they sent out a second email that was basically like, hi, like same thing. This is what we do. This is what we're going to change the world. Would you pay for it? And people paid for it. And they were generating so much revenue that they only had to give away equity very, very, very later on. So what I'm saying is you don't raise for the sake of it, but also like it's not hard to validate. You just need to talk to people. You need to interact with people, so that when investment opens up, which it really will in the next few months, like a lot of people have money that they've been sitting on, you come out with this insanely proven concept and you will be one of the first people to fundraise, as opposed to someone asking now, like you're spending time talking to investors when you should be really spending time on the product. So yeah, cool. So you're at the stage where you protected yourself as a founder, okay? You have your SEIS advanced assurance, you have valued your company, you have validated your product, you know you want to raise equity. What do you do when you actually meet those investors? And how do you find them? Big questions, right? How? First, warm leads from other founders. So a founder who is raised saying, hey, to his investors saying, hey, I have this friend, it's a great company, I think he'd suit you. Those intros are great and they convert really well because it's a very small community. And if that investor does not want to work with you, he will know someone who does. And because he has a relationship of trust with your friend who's the founder he raised with. Okay. So whenever you go into an investor event, when you go to coffee mornings, when you go to WeTech coffee mornings, when you do stuff like this and you're talking to other founders, build those relationships because founders can be your best friends. It's not just investors. Similarly, if you've raised in the past, okay, with an investor, maybe a bootstrap or a pre-seed, and I hope for your sake you've been communicating with those investors. Those investors have friends. You say, hey, like we want to raise more money, like we've done XYZ, like let's do it. Great way to get more investors. That seems quite straightforward though, right? The next part, number 3, is you have to be sector specific. The market is incredibly more sector orientated because angels like investing in stuff they understand. That's not true across the board, but it definitely helps. Okay, now how do you find your sector specific angels? That's very much about being in those ecosystems, talking to the right people, so on and so forth, and building that network and knowing who's who. And that really just comes through grafting. There's no way to automate that. There's no way to go forward. Obviously on LinkedIn, a really good thing is, you know, if there is an angel tag and you can see their sectors, great. And actually that leads me on to the next bit, which is LinkedIn, right? Imagine of how many connections you have, right? 1,000, 2,000, some people have 10,000. And imagine 1% of them come back to you. If you send a message to all of them, 1%. That's quite a few more people that know what you're doing and are interested in what you're doing than before, right? So something our CEO, Anthony Rose, who is the creative BBC player, and he's bought and sold like 3 or 4 or 5 companies at this stage, he said this. He said, you create a catchy blurb, you know, legal tech company looking to change how companies fundraise. Magic words are have SEIS and EIS advanced assurance, super magic words. Looking to raise however much, 650K, email me here. Nothing long, nothing that's like bombarding people's inboxes. Just keep it short. And you'd be surprised who comes back to you. And I'm not like, I've spoken to founders that have said this worked. It was a lot. It was like a 1 in 100, but you just need that one. Obviously, you'd want them to be smart investment. You don't want a bad investor you don't get on with, because bear in mind that most investor founder relationships last longer than most marriages. I'm not even just joking. That's actual stat. Another way that this is an interesting story, actually, I heard this recently, where a founder wanted to test his idea and his friend said, hey, like this VC is running a competition, like you should just do it for fun, like they're based in X country and they're only recruiting in X country, but you could try. And so he pitched in his pajamas with his child who was 2 weeks old, crying, and he made this idea, and this VC ended up investing in him, which I don't recommend you do it in your pajamas at 4:30 a.m. to whatever country, but you'd be surprised which people become your investors. It's very much a luck game. You just need to put your idea out there. But when you do that, you need 2 pitch decks. Do you know why? And this is a trick of the trade. There are VCs that like to mitigate risk in their current portfolio investments. So they look around, they say, who's the competitor? Let's invite them in. Oh, we love what you're doing. We'll give you a term sheet. You go in, you give them your pitch deck, you show them everything. A few months later, they invest in your competitor who has brought on some of the features that you had. Do not let the lights of a VC scare you or actually give you the false ego that you should share everything with them and show them how smart you are. You should have 2 pitch decks. The first is a short pitch deck saying, this is who we are, this is what we do, this is our how, this is our why, okay? And then when a more serious conversation and actual, like you don't need to go around sending NDAs to everyone, but it needs to be clear that this is confidential. You have your long deck with your financial predictions, with your revenue model, with your valuation, with how much you want to raise, all of that, okay? And the reason being is because not only are you protecting yourself against the VCs who I think are working on not great faith, but if, let's say, I'm an investor and I love what you're doing, you sent me your entire deck, all of it. All I'm thinking as a seasoned investor is, who else have they sent this to? Who else knows? And why have they risked themselves like this? So just have 2 decks, be ready, make sure they're clean. And that's a great tip. Now, when your investor comes back and says, I'd like you to model my equity dilution, aka what does my stake in the cap table pie look like? 30%, literally 1 in 3 cap tables are wrong. 1 in 3. Can you believe that? Where you're asking an investor for money and you can't do the basic maths? Now, the reason that 1 in 3 is wrong is because a lot of founders think they can create a cap table, and actually modeling a cap table is a lot harder than you think, and you don't really want to pay an accountant thousands of pounds to do it. So you do it yourself, and they're wrong. And you can imagine the pet peeve of an investor when he hasn't even invested yet and you got the maths wrong. Please don't do that. Please just use one of the cap table generators. There is obviously SeedLegals, it's free. There is CapDesk, there are other ones. Just don't do it yourself. There is no point. Model it, and also it looks a lot cleaner. This is obviously a very complex cap table. That's to give you context though. Like, if you think you're going to grow, you may as well get your cap table right from the beginning. Okay. Great. So you have done all of the aforementioned things and you're at a funding round. Now, I'm not going to deep dive into the terms of funding. I'm just going to go over a few that I think are important. We have a separate webinar just on negotiating a term sheet if anybody is at that stage, but to run through it, let's go. Keep your share class simple. Do not do this thing called the alphabet where people go, I'm going to have an A ordinary share, and then I'm going to B ordinary share, and then I'm going to C ordinary share, and I'm going to put a liquidation preference that like doesn't make any sense. The more complex your cap table is, the more legal liabilities you are exposing yourself to. It's not like, oh, we're just going to give, no. Down the line, when you are raising large amounts of money with very complex structures, those cap tables will be a huge hindrance factor to the point that investors will be like, it's too complicated, we can't do it. It's too much money legally to go through this. And it is, because you're going to raise again and again and again until you just hit a point where you don't need to raise anymore. Keep it simple, okay? When you incorporate, you just want ordinary shares, okay? Ordinary shares, you and your founder, ordinary, right? Voting rights and dividends, right? Then you can have A ordinary shares for your investors. They've invested, maybe they have SEIS, maybe they have EIS. Then you can have B ordinary shares for other investors that are not as important, and they don't get voting rights, but they get dividends. Just keep it simple. You don't need to have a mental structure. Preemption is a very common right. Do not be too scared of it. Basically, it means that if I am an investor and I have 5% of your company and you then go on to raise more investment and give more shares, my 5% becomes smaller, right? Because the pie got bigger. I have the right to buy back the amount of shares that I own, right? So I can pay and buy shares to keep my 5%. That's okay. The one that is not okay, except if an investor owns 50% of your company and he has a preemption right, very different, because he will always have that 50%. It's mental you get to that stage anyway, but he would have that 50%, and VCs will have a problem with that because they're like, well, there's not enough equity, right? He has 50%, you own how much, like whatever. However, a clause that you should avoid, please avoid it, is anti-dilution. Anti-dilution is the same thing, except instead of the investor paying to maintain his share, you are paying. The company is bleeding money to maintain his shareholding, which is crazy. Like at this stage, at early stage, it just doesn't make any sense. Even at later stage, but that's a bit different because some larger investors do want it. Corporate governance. So who's on your board? Like, do you have an investor director? Once again, keep it simple. How many board meetings you have? If you think, oh, we're going to be super transparent, we're going to operate at a really high level, we're going to have a board meeting every month, why would you do that? Do you know how much work it is to go into a board meeting properly and get all the financials? Also, you're at a stage that you're moving so quickly. You're pioneering things every day. You're pivoting there and you're going there. There is no point having a board meeting every month. It's not a systematic system. You're not turning out the same numbers. You're changing and cutting and chopping and every quarter. Communicate with your angels. There's a difference of sending out a newsletter and communicating, but board meetings are different. Same with having an investor director. Like, be careful you don't, with every decision you make, where can we get this subscription and can we hire this person, you have to pass it by someone. Do you know how much time that makes? And they will hate you for that. To keep it simple, you're at an early stage, enjoy the fact that there's no bureaucracy. I can't stress this enough. It's not you being irresponsible, it's just you being realistic. Same with the board. Now, just a few stats, and then I will answer, I think, a question that came in, which is, and don't listen to me, look at the stats, right? How many companies have an investor? How many companies have an investor director? Okay, where you're raising about 150K, 30%, 20% of founders suggest it. Okay, 30% actually have an investor director, like 1 in 3. It's nothing. Okay, however, where you're raising over 800K, you're really entering Series A territory, right? 65% actually have an investor director. It's very clear, because obviously the more money you're dealing with, the more you need that oversight, and the more you're less of a startup, more of a scale up in a structured company. If you're thinking, okay, where should my valuation sit? Now, look, somebody in Accelerator once said, don't follow this graph. Like, you need to pay yourself what you're worth. You know, if you have a family, like, you need to pay. That's true. You need to pay yourself what allows you to survive. She was right, because you need to, you know, if you're not coming out of uni, like, you need to support your family. Like, if you're unsustainable, your company will be unsustainable. However, I think there's a difference there between taking what you need and taking what you think you need. And the more money you take from the company, the less the company has. And to be honest, 20 grand does go a long way. So again, you can choose, but the stats are that where your valuation sits at about 2 million, so pre-seed stage, your salary is about 21,000, around there. Where you get to 6 million, you're hitting 80,000. Where you get to 10 million valuation, you're at 120 grand. So, you know, it grows. And this is, you can see the distribution here, it very much sits there, but we've had differences. Like, you know, some people have had 140 at a very much lower valuation. It does vary. In terms of share vesting, as I said, how many companies have share vesting? Or 65% do, 34 don't. I don't know how those founders have that, but you know, in terms of the year, like, look, half of it is 3 years. So if an investor is saying we want you to have a share vesting schedule for 8 years, they're very much on the spectrum there. Okay. Proportion of founders with a salary. So this is quite interesting. Where the fundraiser is under 150K, half have a salary, because a lot of the time you're bootstrapping anyway. Where you go above 150K, it changes drastically, and 73% have a salary. So warranties will come up. Basically, where you sign a warranty, you just have to disclose everything that's not working. So like, if there's a broken desk, a broken computer, someone's unwell or something like that, these are all the little details you have to disclose for legal reasons. Just that people forget sometimes, so be aware. Now, I've said a lot. I've said a huge amount, actually. And you're probably thinking, okay, that's great, Bella, but like, how do you want me to implement a founders agreement and an IP assignment and all these things? Well, it's really, really, really simple. And I'm going to share my screen with you one more time, which is basically that the reason that SeedLegals was created, and this is going to sound like a sales pitch, but I actually believe in what we do, which is basically that we automated all of these things, and it's not for a financial incentive, because the founders agreement is free when you sign up for the first month. And if you don't want to continue for the first month, you're allowed to download it. Okay. The IP assignments are free, and I'm just going to share my screen again, which is like this. So we can enter a new screen. Here we go. When you sign up to the platform, look, all you have to do to implement what I've done is go to quick agreements. All of those agreements are there for you to create and use. If you're not too sure about how they work, it's really simple. All you have to do is answer the questions, fill in the terms, and then we generate all the documentation. And you're probably thinking, okay, you know, what exactly does that mean? And I think, to give you context, let's just look at one agreement. It's really, really simple. All you do is, let's go to a founders agreement. Rather than you seeing all the terms and being very confused, all you have to do is fill in these questions based on, you know, hundreds and thousands of founders agreements. These are kind of the state-of-the-art documents, and then we generate the actual terms. So this is where the technology comes in all the legal jargon and all the padding. and all the phrasing of it. And then if you're unhappy, all you have to do is change the terms again. And this goes through from your getting your advance assurance to getting your founders agreement, signing off your company, and so on and so forth. So if anybody's interested, it is there for you. Just get them in place, protect yourself as a founder and such. Now, my last thing, I know my presentation is off, is once that money is in the bank, I would recommend implementing an EMI option scheme, which is basically, rather than giving shares to your employees, you give them options. It's a much more tax efficient way of doing that. And it's a great way to attract top talent. But that's a complete side note. That is for very much growth stage. But the great thing about an EMI option scheme is when you have one in place, and an investor can see your prospect of already growing, like you're already thinking about the fact that you're going to be hiring. So that's it. So now we can hopefully open up to some questions.
We can. That is a big effort from you. I know talking for half an hour to your computer is not easy, having done it a couple of times over the last week or so, Isabella. So, big intake of breath for you. First, there are some questions in the chat that aren't in the Q&A, so I'll go through them as well as the ones that have come through in the Q&A. So, the first question in the Q&A is from Yasmin. What about when a company pivots? Do you have any tips for effectively communicating to investors that the business they've invested in has changed its focus?
I think that's a hugely timely question. And the reason for that is because when lockdown hit, right, a lot of companies either stay the same, so like, we're not going to change our marketing to cater to what is, and some companies change. Now, what investors were saying is we want our companies to be a product market fit, right? So what does that mean? It doesn't mean just being a product market fit 6 months ago when things were normal. It means being a product market fit in the current moment. And actually the ability to pivot to cater to changing environments is incredibly important to investors, because all they're thinking is, look, when we hit another financial crisis or another pandemic or another, terror issue, how will you react? Are you going to sit down, or are you going to do something? So the difficulty with pivots is they're expensive, to be honest. But if it's a pivot that makes sense and you have a proof of concept, kind of like when you're starting your business, you need a proof of concept, then they're completely fine. And the best way to communicate that to an investor is saying, look, this is what we did. This is what we got. This is the situation now, and this is the response we've got. So as long as you have that proof of concept of people actually wanting to use this new thing you've created, then you should be completely fine. And they will normally, if you have a good relationship with them, will be more than happy to help through that process, because they believe in you as well as the company.
So that takes us back to probably just at the start of your presentation, you talked about the landing page story, and I was busy doing a whole bunch of other stuff at the time. But Tim asked a question which follows on from proofs of concept and MVPs, and he asked what a landing page was and how that was relevant to that story.
Yeah, so really, really simply, like, a landing page is basically like if you created a website, right? You have your homepage, and that's the landing page. It's when somebody puts in your URL and types it in, they will come to your landing page, which is your homepage, and hopefully that homepage will tell them very quickly what you do and who you are. So what Buffer did is they basically said, look, we're going to make your social media posts 100 million times easier by you can schedule them at 5 p.m. rather than waking up at 4:30 a.m. to post in America or post in Australia. So for example, if we look at, I don't know, the SeedLegals landing page, look, you might not get, but we think start raise growing faster with SeedLegals. The reason I use this one is because I obviously look at it every day. So when you're thinking about validation, it doesn't have to be this complex thing. You need to build out your product. You just need to, what problem are you fixing? We're fixing legals. If you said to someone, hey, I'm going to do this for you, and they say, yeah, great, like, that's super useful, I've been looking for that, then that's validation. And it's just a matter of getting that from a lot of people. So websites, type forms, LinkedIn polls, surveys, all campaigns, all of those things are really, really good. So a lot of SaaS companies, to get users early on, is they don't even build the product. They literally don't build anything. They go onto Instagram, and if you're selling, I don't know, water bottles, and they post loads of pictures of people drinking water bottles and really nice water bottles, and then you get loads of followers, and then you can get emails, and then when you actually launch, you have all these emails and all these followers. So there's loads of ways, but basically a landing page is your homepage, to answer the actual question.
Thank you very much. Question from John. So do SeedLegals do any due diligence on the companies on their platform, including, is the valuation sensible?
So we are the in between, like you find investors, and then when you want that deal to go through, you come to us. We do all the documentation. We don't source investors. We're not. It's not something we want to do, and we don't want to make a judgment. However, do we check everything? Do we check your company's house filings are right? Do we check that? We will never. It's not our place to discuss your valuation. We will give you data on what the norm is, but that's a conversation you'll have with your investors. If your cap table is looking a little bit strange, we will probably say something and say you might want to check this. Is this sure what you want? If you implement some really difficult share classes, but we don't technically do the due diligence. Like we're not sourcing companies for investors. No.
Thank you. So a question from Bob. So this is the stuff that's coming out of the chat. And just before I start to answer the questions, because there were 3 that came through specifically on chat, I know that there are more than 20 people on the webinar just now, and I'm sure more than 4 of them have got a question that they would like to ask. And I think that we're happy to answer all questions relating to early stage companies and how investment can be achieved. So a question from Bob this time. So Bob's question is, what are your thoughts on how to split equity between founders?
So basically, when you're starting off, just to keep, because in HMRC, the minimal price per share you can put when you incorporate is like 0.001. So you start with like 100. If you're 2 founders, you start with 100 shares, 50% each, 50 shares each. That obviously varies. Like if one of you is full time, one of you is part time, it's between you two to come to an agreement as to how much you can commit. And what share vesting schedule you want to be on, or maybe you want to do it by milestones. That's really depending on you. But let's say it's really equal. You're both into the company. If you're 3 founders, then you want to start with 300 shares because you can't split 100 by 3. It becomes 33.333. It's a decimal. It doesn't work. You want to do 300 shares where you get 100 shares each. The reason that we only set 100 shares as you incorporate is because you can only pay that minimum amount per share. If you set like 1 million shares, you're going to start paying 30,000 pounds just to incorporate your company, which is mental. However, what you do then after is you do a share split, which you can do on SeedLegals or you do through Companies House, which is free, where you create 1 million shares or 100,000 shares. So you don't actually add any more shares, you just split the amount you will have, and then that allows you to actually go through a round, because in minimum you need 100,000 shares. So yeah, so if you're 2 founders, it's probably 50-50. That makes most sense. Also because if you don't have 50-50, or if you have a really bizarre split, your investors are going to be like, I don't understand, like, what's the difference here? Like, does that mean he's not working? Like, so don't give them that kind of doubt, but also be careful that you are doing it based on the merit, because I have had founders come through before saying, well, he's not pulling his weight, and now we've signed the founders agreement. Like, what do we do? Which is why share vesting is super important, because you have to meet your milestones, and you have to commit to the company to be able to cash in on your shares. But it's a very complicated question, funnily enough. So I hope that helps in the slightest.
I hope so too. And Bob, if that doesn't help, feel free to post another question and we'll try and address it in a different way. So this is a question from me. I just was thinking about when you were talking about the section on 2 pitch decks. I noticed on your newsletter, the newsletter that you send out weekly, I think, that Anthony was doing a pitch deck clinic a little while ago.
Yes, he is.
So is that still happening? Or maybe talk about that a little bit, Isabella, and tell us whether that's still happening, because that looked to me to be something that would be very interesting if you were somebody who was getting into the place of putting together a pitch deck and looking to put it in front of investors.
Yeah, so that's actually something we were just having a company meeting, and I was running a lot of founder interviews at the time, and he thought, and Anthony's he's our CEO, and he's super and he basically said, look, I want to run pitch deck clinics. This is not like just he himself, he's built and sold so many companies, and he has like no time. He literally will go through your pitch deck and pull out, he's harsh, don't get me wrong, and pull out all the issues in it and everything you should improve. But we film it. And then we have it edited, and then he wants to kind of post it on the website. Obviously, you don't need to have it posted. We understand that some companies don't want that out there, but it is a really good publicity thing, even though it doesn't seem it. But more than anything, you get his insight, which is really good. In terms of how to get in touch, basically, I'll put my email in the chat. Tell me if you're interested, and then I'll put you forward to the team that's dealing with that. But you guys would very much be early birds, because we haven't really gone full throttle yet. So I would sign up. It would be great.
And just in terms of the time, because I read it, Isabella, which was that it's half an hour with Anthony, and then some suggestions as to how you can make it better. Then you go away and do some homework to make your pitch deck better
Yeah,
based on his
and we'll do
feedback,
the
and then you
comparison.
resubmit it and you do a comparison. And
Yeah,
ideally, what
exactly.
Anthony wanted to do was show a before and after. But as you say, I'm sure that Anthony has seen hundreds, if not thousands, of
Yeah,
companies, and has started and exited many himself.
yeah,
So invaluable to founders who are looking to. And I can see already there are some people in the chat who are interested in that. So if there's a way for
yeah,
people to connect with that, that would be great.
yeah.
Question from Samuel here. How complex should your financial model be for a pre-seed startup? How far into the future should you look to project?
I mean, look, like I honestly, financial predictions are not necessarily my like area of expertise, and I'll be super honest about that. But as a rule of thumb, and this is just what I've been taught and what I've seen and what other founders have said is if you start pulling out numbers like we're gonna own 3 trillion of the market, like an investor's not stupid and actually insults their intelligence a little bit. You need to be very realistic and if anything a little bit humble um, in terms of what you can achieve with the money that they're going to give you. And I think that realism and that actual education into what you're predicting is what allows them to build trust with you because they're aware that you can't go from a pre-seed to like a $1 billion company in the space of 6 months. In terms of how far, 3 years is generally what I've seen. 3 year financial predictions is the norm. Some people go further, some people go less. And then I think your best thing is really working in those 6 to 12 month landmarks. However, and this is a complete tangent, but I completely forgot to say it. You know, when I said that everybody's raising 1 to 2 times a year, yeah, that's not the same. Actually, that's completely shifted with some innovation, but also lockdown, because people can't meet enough investors. And you're meeting investors one to one. Like, let's say me and Martin were on a call, and he says, "I love the company you're building." I would typically have to say, I'm really sorry, like, we're only raising in September because there's no money on the market. That's not the case anymore. If anybody is looking to raise now ahead of their round, please email me because there are two things that are super important, which is a thing called an advanced subscription agreement or a seed fast, which allows you to raise ahead of your round and not set a valuation. And it's great. Everyone's using it. And an instant investment, which allows you to top up your round. Basically, if you close your round and you don't have enough money, you can close it and top it up later and find the right investors when and where you need to. So that's a really small nutshell of a very big topic. But basically, if you are looking to raise, but you don't want to go through a funding round, there are so many ways to do it that didn't exist about a year ago. So to answer your question properly, 3 year financial predictions and keep it quite honest and humble and don't pull numbers out of nowhere.
Super, thanks very much. So there are some questions around about your pricing, but I don't really want to get into the specifics of your pricing model for SeedLegals. Where can the audience go to find out what the tiered pricing model is for SeedLegals?
Yeah, it's super simple. I'm actually just going to put it in the chat now. We we are here for startups, so if you think you're going to see lawyer type fees, you're not. Automation has
It's more
allowed us to
SaaS.
keep, yeah, automation basically. It just means that we're not spending the time on the contracts. Like obviously we spent time on the contracts, but once you automate them, we're not going to charge per hour because we don't do it. So you can look there. And if you, so I think Sam said who should I reach out to? Just my email. I'll put it in again. But
Yeah, if you scroll up, it's in the chat there. There we go. Thanks very much. So another question from Tim. Tim would like to understand when you see the market open again for investment. Now, from what I'm hearing there's still some investment going on, but what's happened in the past 12 weeks or so from your perspective, and when do you see the market going back to a place which startups are more
yeah.
familiar with?
Yeah, so there's a lot of points that I think to dispel a huge myth, the market never shut down. Like if you compare the amount of money circulating through investment in startups compared to 2016, we are even at our lowest point so far from the minimum there. So that's one. Number two is when lockdown happened and everyone thought, oh my God, all these rounds didn't go through. No, 75% of rounds did go through, 25% did not. Obviously, that 25% encompassed, thousands of companies. But what we kind of found is either they got very unlucky, they shouldn't have raised in the first place, or their investors basically had spread themselves too thin and didn't have enough cash flow. What the market looks like now, the market is operating. The stifling bit is that meeting investors is harder. So that luck game of like, I'm just going to meet an investor is more difficult because it's one-on-ones and it's intros. You're not going to events, and so it's a much harder in that sense. So that will return to normal basically when COVID and lockdown change. I think the best thing though is doing those pitch events. So We Coffee, literally it's called We Coffee. They run great pitch events. I think once every month. Exponential events run some. So there's a lot going on. In terms of anybody who's looking for larger tickets, the evergreen fund VCs, so the ones backed by family offices and stuff, they're not investing, they're waiting and seeing, as they say. But the traditional VCs that operate on a 7-year basis, like I can't remember their name, but it'll come to me. They can't wait a year. Like they have money, they need to deploy, they are deploying it. You just need to reach out to them if you are on the larger ticket size because they're looking for good companies. But once again, they can't meet anybody, so it's a bit difficult. But they're all investing. They have loads of money, loads of money. So that's kind of what it looks like. I think we've seen a higher peak in activity actually in the last 2 weeks, which has been really good, really good. And then but what we haven't seen is funding rounds. As I said, like we recently closed like a 3.3 million round, but there was no round. It was all like seed fasts and convertible loan notes and instant investments and no actual round. It's a lot of continuous funding. So full disclosure, normality will resume when people can meet each other because of the volume. But in terms of what financials have looked like, that's what it's been like. But there is definitely money on the market, so you don't need to think otherwise.
Nice, thank you very much. So this is my final call to anybody who might have a question for Isabella, because at the moment we've exhausted everything that I was diligently writing down whilst we were doing a presentation, everything that's come through in the chat and everything that's come through in the Q&A. So good job from you. It's a big shift, 50 minutes of chatting. I think on that basis, Isabella, thank you very much. It's been lovely to chat to you. I think that the people who have been out there have asked some great questions, and you've done a really nice job answering all of them. So many thanks, and I know that you and I'll probably catch up very soon anyway.
Yeah, great stuff. Well, thank you everybody. Have a email. I'll put the email one more time. I should see. Usually I would give out a business card, but we can't do that at the moment. At SeedLegals. Yep. So that should be it. All right. Thank you everyone. Thank you so much, everyone. And Martin, I'll speak to you soon.
Indeed. Bye-bye. Thanks. Bye.